What is up, my Pro Design Builder family? This is Sam, also known as the Pro Design Builder, bringing you another training video. I'm the best in the business, and it's not even close. And today we're going to be talking about an interesting topic, but I'm going to treat it as more of a introduction. And the reason being is it's a lot to take in. We're going to be talking about what is a capital stack. All right. So if I had to rank this particular training, I would say I would rank it around an 8 or a 9. No, actually, what am I talking about? A 9 or a 10, right? Reason being is when you are speaking the language of capital, right? That means you have significant experience. That means you're talking to funds. That means you're talking to different financial institutions in the way that they receive the information that you're talking about, right? So today, when we're breaking down what a capital stack is, I'm going to really be teaching it as an introduction to capital, right? And the terminology and how capital receives information and how deals are structured, right? Typically, when you're talking about a capital stack, you're talking about a significant investment that's being made for a development project. We're not talking about hundreds of thousands here. We're typically talking in the way of millions of dollars that you are managing or structuring together to put a new development project together, right? So my name is Sam, also known as the Pro Design Builder. This group is specifically for real estate investors that are looking to make the leap into new development. You may not know where to start. It's a lot of information. It's a lot of hoops to jump through if you really want to make a six-figure return on any new development project. But that's what this group is for, right? I'm here to be your guide when you are ready to make that leap into new development and streamline the information and the process and the steps to understanding exactly what you need to do. And this is what this particular training is about, right? So I will say to you, don't eat the whole apple in one bite, right? How do you eat an elephant, right? You eat an elephant one bite at a time. And then once we've made this introduction to you and you hear it again and you are around people that are speaking the language of capital, it'll make perfect sense to you. But as a first-time introduction into what a capital stack is, it may be over your head. Like I said, this is a 9 or a 10 type of training, but I wanted to make this introduction to you because I feel like everybody has the ability to grow into this level of developer, right? Where we're speaking about capital in this way to structure deals that are bigger whenever you get there, right? But I wanted to give you that introduction now. So first off, if you don't know my story, I was a house flipper for about 5 years, right? But before that, my wife came to me and she had gotten into med school and she wrote me a letter and said she didn't want to go. And then from there, what happened was she handed me a book, which is Rich Dad, Poor Dad. I read it. It spoke to me. We went to a seminar that was very good, but I needed one more seminar to grasp the concept. And then from there, I started just putting what we call messy action into play. I was very green as an investor, but I'm very ambitious. I'm open to learning, and I just started just doing everything that I had learned instead of freezing and waiting until I know everything. I started making steps, right? Taking steps right away, right? But I had a friend at a title company that would help me. And I'd be able to call him and he'd tell me, hey, Sam, this is what an escrow is. Don't put it on this line. He was going to handle all of the title work. So I was able to get through my first few deals. And what happened was, once I actually started flipping property, then on my first flip property, I hired a contractor, I fired a contractor. I hired a second contractor, I fired a second contractor. I hired a third contractor. Thank God the numbers were good. And we finally got through the project and we made money. But I saw some flaws in how contractors operated, how they planned, how they pursued their jobs, and I made a decision that I was probably never going to be happy with the level of contractors, the way that I saw them operating. And from there, I started managing my own projects. All right? I got really good at getting in and out of projects and managing them on my own, learning on each project. I use YouTube to really figure some stuff out. And then from there, what happened was, after 5 years of house flipping, I got so good at it, it just made sense to become a contractor, because I had this thought. When the economy was, good, I'd be a contractor. When the economy is bad, I'd be more of a flipper. But what happened was, after I became a contractor, I realized I didn't know anything, right? Because I had been copying what I saw these other contractors doing, and I didn't know my head from my tail. So I found a mentor, and the mentor introduced me to design build. And what design build system is I take a client from concept to completion, from sketching it on a paper where it don't exist, to putting together plans, to getting our architect involved, figuring out why they want to live the way they want to live, getting the designer involved, selecting all of their finishes, doing all the permit work, doing all of the selections and ordering, and then taking the client through the actual construction process. Very smooth process once it's done correctly. But it taught me a lot of things, right? So I use those skills to help people like you, real estate investors, go to the next level, because I'm accustomed to taking concept to completion, right? So that's what I've been doing the last 8 years, and now I'm focusing on helping investors make this transition that seems like a daunting task, which it is. There's a lot involved in taking on a new development project, but once you do it once and then twice, then it becomes second nature, which is what it's like for me. So today I wanted to talk about what is a capital stack, right? And I wanted to first define what a capital stack is, right? So the capital stack refers to the hierarchy and structure of financial sources used to fund a real estate or business investment. It represents how the total capital for the project is organized, detailing the order in which various investors or lenders are compensated in case of a distribution or a liquidation. Each component of the capital stack comes with its own level of risk, return expectations, or rights to cash flow. Right, so there's several different tiers when it comes to a capital stack, right? And the way that capital stacks are typically positioned, pretend it's a slice of pizza, right? And since we're talking about construction and we're talking about new development, the best way to describe the bottom or the foundation of the capital stack is senior debt, right? Senior debt is typically whoever is the most invested into the project is typically the senior debt. Now, this could be a little bit different by what I just said. Senior debt is typically a financial institution, and in new development, senior debt is typically a construction loan, right? They have the first right of refusal. They are the first to get paid if something happens or the project goes south. So let's kind of break down what senior debt is, right? It's low risk, lower returns, right? So secured by the property or asset, right? So they receive the deed of trust, just like a mortgage, right? The mortgage would be your senior debt, right? And anybody else that's putting on or working on your property, those are going to be secondary, debts or to the actual property. So let's break this down, right? Secured by the property or asset, first to be repaid in case of a default or a sale. It typically includes loans from banks or financial institution, which is the most typical way you'll see a senior debt position, especially when we're talking about new development, new construction, right? Often has a lower cost of capital, but the strictest repayment terms, right? So let's say you acquire a construction loan and it's at, let's say, 10, 12% on the construction loan. That's APR. So annually you'll pay that. So break that down by 12 months and that would be your annual percentage, right? So they typically have I would say a deadline, but anywhere from 18 months to 24 months is typically the time frame that they want to call this project due. They don't want this project being a run-on project. They typically like to lend to experienced investors, right? They could acquire bigger and bigger construction loans. So that's what that is. And then there's tiers in the senior debt position, which is very important because senior debt gets paid out first if there's some sort of calamity or liquidation that's needed. So the first tier is going to be your financial institution. Your second tier is called your second lien, but senior debt. Not backed by the collateral. That's important for you to know, but they are positioned in a way that they get paid first after the first lien holder, right? So they're the second lien holder in that particular project, right? So the next tier of the pizza, which I would say would probably be your actual shell of a building, right? The shell is all your exterior walls and roof sheeting, right? So that would be your shell. This is called mezzanine debt, or they call it sometimes they call it Mezz X, Mezz funding, and I'm going to break this down, and then I'm going to give you some examples of what mezzanine debt looks like. All right, so a hybrid of debt and equity sitting between senior debt and equity in the property, often unsecured. This is very, very important for you to understand. Often unsecured and subordinate to senior debt, right? So it's telling you exactly where it's positioned. It's positioned is subordinate to the actual senior debt, right? So typically, mezz funding, because it involves risk, they're positioning themselves where they get a sliver of the deal, plus they get a higher interest rate or a higher percentage for the loan, right? And I'm going to break down some examples. So returns are higher than senior debt, typically structured as an interest payment and sometimes warrants or equity kicker, right? So let me tell you about what this looks like. So what you might structure a deal, right? You have your analyst put together the financial package, the financial numbers, right? You know you could get a construction loan, but your mezz funding will typically come from some sort of fund, right? And there's a couple of different types of funds, right? So you have institutional capital, which is, I would say, funds that are like insurance companies. Those are the main ones that are sitting on a lot of cash, right? And they typically like to get great returns on their investment, but they might have stipulations on there where they require you to come with 7% of the cash on the deal, so you are invested in the deal, right? So I remember early on looking for capital, right? And I remember one of the questions that I got asked by a friend. He said, "What is your risk in the deal?" Right? And funders want to see you invested in the deal somehow. So to position yourself, correctly, you need to be invested in the deal somewhat. So that's going to be important for you to know and understand what they're looking for. The other mezz that you could use as a vehicle is self-funded IRAs, right? So if the IRA, self-directed IRAs. So there might be a fund that controls a number of self-directed IRAs, and they're looking for opportunities for their clients to invest in certain projects. So if they get a cash on cash return, which you're looking to give them, and then they get to participate in the upside. Let's say they get to participate 5% in this particular deal on the profit side by lending you, this, large percentage of cash, right? They know and they understand that this comes with risk, right? So they are reviewing the numbers and making sure that they work, and also your experience level. This is why it comes with experience. Now you have several projects to show that say, hey, listen, this is what we do as developers. We're seasoned. We understand our playground. We understand what we're looking to produce, and we've done this before, right? So this is why this is very high level when we're talking about funding a development project. So that's what mezzanine debt is: moderate risk, moderate returns, but they get a equity kicker to participate in the project on the profit side. So this makes it more appealing to the capital, so you could receive that investment, right? So the last two of the pizza, I would say the preferred equity, right? I would say that's the guts of the home, or the guts of the new development project. That's your framing, that's your MEPs, that's your finishing, right? So that's all of that stuff on the interior to beautify the project, right? So let's break down what that looks like. So preferred equity, higher risk, higher return, provide fixed returns, prefer dividends before common equity compensation prior to cash flow distribution, but does not have the same collateral protection as debt, often used by investors seeking steady returns with some upside potential, right? So they know and they understand that this particular position in the pizza has very high risk, but if they're getting a better return than the stock market, this is a appealing investment to them to participate in this type of project, because the returns are going to be bigger. You can share part of the pie with this particular stakeholder, right? So that's what that potentially looks like, right? And then the last piece is at the very top. Now you have your foundation, you have your shell, you have your guts, your interior, all your finishes and stuff like that. Now the project is completed. So the position that you are in as the developer is common equity, right? It has the highest level of risk, highest level of return. Right, and this is kind of how it breaks down, right? So represent the ownership stake of the project. You're the last to get paid, but sometimes when you get paid very well. So last to get paid after all other obligations are met, carries the highest risk because repayment is contingent on the success of the project. Very important, right? But you want all of your investors to win, right? Including yourself. So those people get addressed first. All right, offers the greatest potential for upside if the project performs well. All right, so I'm going to tell you about a project I was representing. So I was the broker of my friend Josh on. Right, and I'll tell you, I saw his performance. I'll tell you what this particular project looked like. These numbers were very big, right, and it was all right. So here's how the deal broke down. Right, so it was I forget how many total units involved, but it was several hundred units. The construction loan was like 52 million. The mezz loan was like 20 something million, and they were going to need to participate that 7%. I think they were looking at somewhere about 77 million all in to get this high-rise project off the ground. And the profit that they were projecting, because they were merchant builders, all right, so merchant builders, what they do is they build the project, start to allocate and hire the people to fill all of the rentals, and then from there they put it on the market as a cash flowing asset for a fund that wants to hold and cash flow, right? So that's kind of what they do, and they want to sell as quick as possible. So that's what that deal looked like. So it was 77 million all in, and the sales price what they were looking at, this is pre-COVID, was looking at 110 million as an exit. So his profit, once everybody was paid and they took 2 to 3 years to get this project completed, was a little bit over $30 million, right? So when I'm talking like that, obviously this is not lightweight stuff. When you're talking about high-rise building, you need significant capital, you need significant experience, and you need significant investment and relationships to be able to even be in the running of a project like this, right? So, that's going to be important for you to know in the future once you've gained a level of experience that you need to put together projects like this. And it's not for the faint of heart. It comes with a lot of stress. It comes with a lot of litigation, and I just got to be very honest with you. But the windfall at the end of those 3 years, on average, it was about $10 million a year to put this all together, right? Staff of 6 people, 7 people, one project, looking at a return of 30 million plus other projects that they have going on already. Doesn't sound bad, right? Your labor is not high. You have a team of professionals working for you to structure your deals and to also sometimes get boots on the ground to, and then you always want to hire the top 2 or 3 construction companies to perform that sort of build for you, right? So I'm going to break this down, this capital stack, with real numbers, so you understand exactly what this looks like, right? So, I'll give you an example. Right? So let's look at a $10 million project and see how it's structured with the capital stack, right? So $6 million of it is senior debt from the bank, secured. It's a secured loan to the property, right? Then $2 million of mezzanine debt from a private lender, $1 million preferred equity from investors, and then $1 million common equity from your sponsors and partners. So that's kind of how that particular deal would be structured in a capital stack situation, right? So I didn't want to throw too much at you. Like I said, you eat an elephant one bite at a time. But I felt like it was important for you to begin to start processing things in a way that developers and high-level developers are processing capital and speaking about capital. Right. So if you ever have any questions, feel free to leave comments in the comments below. I'm an open book. I want to help you win. I want to help you get generational wealth, for you and your family, and for whatever your ambitions are in the future. Outside of that, Pro Design Builder, Sam, the best in the business, and it's not even close. Have a great day.